All right, so covered calls is the topic for today. As Matt said, we've been focusing on covered calls for the last bit here at Tackle Trading. I'm going to build a covered call on a Tackle 25 stock. This is a watch list that we have that we think are decent fundamental stocks, decent technicals that are good cash flow candidates, have good premium. And in building this out, what I want to focus on, there's lots of advantages, there's lots of perks of covered calls. I want to focus on the volatility reducing aspect of a covered call. So to set the stage here, the structure of a covered call is you're going to buy 100 shares of stock and you're going to sell one call option against it. And when you sell that call option, you're getting paid for a promise to sell your stock. Okay, you're obligating yourself to sell stock and you get paid. That payment, that premium, we often say is potential cash flow. It offers protection against a little bit of a loss in the stock. It reduces your cost basis. It makes it cheaper. The overall position is cheaper. If I buy a stock for $100 and I bring in $1 from selling a call, my net out of pocket goes from 100 to 99. And so now 99 is my break even on the position instead of 100. When you lower your cost basis like that, it increases your probability of profit. So you have a better chance of making money with a cover call than just buying stock, which is one reason we like it. So we can focus on those 4 perks if we wanted to. But the one, as I said, that I want to hit on today is the volatility reduction. I think this is pertinent and relevant and timely because of what's gone on in the market here recently. If you take a look, as you guys know, the market's a little crazy. We've had a lot of volatility. And if you're going to buy a stock and then put it in a drawer and not look at it for 10 years, you probably don't care about the volatility. I don't care how volatile it is. I'm not paying attention. I'm not just fast forwarding to the end. But most people don't do that. Most people, especially active traders, we're looking at our portfolio each day. We're monitoring the risk and the exposure. And when volatile times like what's gone on this week crop up, you get more emotional, maybe a little fear creeps in. Maybe you found that you were overexposed. So the idea of reducing the volatility, reducing the ups and the downs in a portfolio can be quite attractive in a situation like this. And that's where covered calls come in. So the best way to think about your exposure, right? Which the more exposure you have, the more volatility essentially you're going to experience, okay? I don't know that anybody who just owns 1 share of stock is all that worried this week. But if you owned 1 million shares of a stock, you're probably not having a very good experience because every day you're seeing your portfolio have massive swings. And so the number that we're going to use here for exposure is we're going to use the delta. This just tells you how much you make if the stock rises $1. Alternatively, how much you lose if the stock falls $1. So the higher your delta, the more money you make or lose. Okay. When you buy a stock, so I'm going to go long 100 shares of stock. My delta is positive 100. I make $100 if the stock goes up $1. I lose $100 if the stock goes down $1, right? So that is the degree of my fluctuation. If this is a stock that moves $3 a day, I'm probably seeing my account go up 300, down 300, up 300, down 300. Well, how could I reduce that? How could I minimize the level of fluctuation? I could sell a call. So if I sell a call option, this is a bearish trade. When you just sell calls, it's a bearish trade. You're adding a bearish trade to your stock position. Your stock position is a bullish trade. You're adding a bearish trade. And so it reduces the overall exposure. It offsets your risk. It hedges your original position. So if I sell a 40 delta call, think about what happens on an up day for a second. If the stock rises up day, stock rises $1, you make $100 on the stock. Okay. The call option will go up in value by $40, but you're short that call option. So that's a negative to you. So you would lose $40 on the call that day. So think about the overall position fluctuation. Instead it's going to go up 100, it's only going up 60, right? On a down day, by the way, you might think, oh, that sucks. I wanted to make the whole $100. Here's a key point. What you discover is in an efficient market, anything you do to suppress your downside risk, your downside volatility, will to a certain extent suppress how much money you can make, right? It's not really possible to simultaneously reduce risk, but have all the upside, right? So on an up day, yeah, you don't make as much on the upside, but think about a down day. On a down day, if the stock goes down $1, you lose $100 on the stock because you own 100 shares. But this 40 delta call, you're going to make $40. And so the long stock trader, their experience is plus 100, minus 100. That's how much fluctuation they had to sit through. The cover call trader's experience was plus 60, minus 60. They made $60 on the up day. They lost $60 on the down day. The key point here is not how much money they made or lost. It's the level of fluctuation they had to sit through. And so if nothing else, if for no other advantage or reason you did covered calls, I didn't say that the right way. If you didn't care about any other advantage of covered calls, just this principle alone, this ability to reduce the volatility of a position, I think is a good enough reason to explore the strategy. And I got to be honest, it gives you a sense of control that I can sell calls against stock when the market gets messy. I can immediately reduce exposure and thus lower my overall fluctuation. You don't have to essentially be at the mercy of the volatility here over the last 5, 6, 7 days. When you understand how to sell calls, you can shrink your exposure. You can reduce your overall risk. So I want to share an example of what that looks like on Camping World. Okay, I went through the Tackle 25 list. Camping World has held up quite well over the last couple of weeks. I like the long-term trend of Camping World. It's fairly stable. And the other thing that looks really good with Camping World is there's a lot of value in the call options. Camping World's a volatile enough stock to where the calls have pretty good premium. So you can build some trades that have a pretty good return on investment. Now, I don't know about the timing today based on the way that the market's going with this gap up getting sold into. Set that aside. Just focus on the principle for now. I'm going to buy this stock for, let's just call it $44. Okay, and I could leave it at that. I could just buy the stock, buy 100 shares, making dollar for dollar as it goes up and down. But if I want to shrink my exposure, I'm going to sell a call against it. Maybe I'll sell a 40 delta call. That'll cut my exposure by 40% initially. And then my experience day to day is going to be about 40% less emotional, 40% less fluctuation. And that changes with time. But initially, this is the way it works. So the traditional kind of rule for a covered call is you maybe go out about a month. And I'll tell you right now, like December monthly options, there's not really enough time. So I'm going to go to Jan. And the delta, think of this as the amount that you're reducing your volatility in percentages. If you sell an 8 delta covered call, you'll reduce the volatility of that position for the next dollar, about 8%. Not very much volatility reduction, okay? If you want to really reduce the volatility of the position, you sell a higher delta. If you want to reduce the volatility by 50%, sell a 50 delta call, right? Well, because of multiple reasons, we don't tend to immediately sell really, really high deltas because the trade-off is it caps how much money you can make in the stock. But let's say in this situation, I want kind of a nice balance between still being able to make some money in the stock, not capping my gain too quickly, but reducing the volatility by a good 40%, right? So I'm going to sell this 38 delta, I got my girl here. Hang on, baby girl, hang on. I'm going to right click. I'm going to go to buy covered stock. Okay, right, buy covered stock. So what this will do is it'll buy the stock, sell the Jan 47 call, and I can confirm what my overall exposure is going to be, if I just right click and analyze this, take it over to the Analyze tab, I can see that my net delta here is 61. So a long stock position, 100 deltas, covered call position, 60 deltas. And so that net delta number, again, is what we use to measure the amount of volatility in the position. By selling that call, immediately reduced the exposure by 40%, about 40% or so. So, all right, I'll leave it at that. That, I think, is a great way of looking at covered calls through the lens of volatility exposure and delta.
Tyler, I absolutely love that. Thank you so much for a wonderful edition of Jedi Options. And cover calls are such a great way to bring in some cash flow, to compound long term, and to think long term about both growth and cash flow. But I love the take today on volatility and being able to reduce the exposure to volatility, because that is an additional benefit as well. Tyler, thank you so much. Final thoughts to you, my friend.
Yeah, look, as we're going out here, I'm going to be interested to see, Matt, do they puke all this up? Do we see a late day rally? This candle is shaping up to be not a great candle. And if you really want to feel pessimistic, go look at IWM, which gave up about 2% of gains in the last couple of hours. I think caution rules the day here. Minimizing risk over maximizing gains is my priority. And you just got to be patient. You can't force it. Sometimes we want to trade every day, but if the odds aren't there, sometimes it's just you chill and you wait for an easier pitch to swing at. This is a tough response to an up gap. I'm not surprised, but it just reinforces to me that I got to be cautious right now.